Good morning, everyone. What if I told you there's a way to profit from time itself? That's right. Option traders can use time decay to their advantage instead of watching it drain their trades. Super microcomputers SMCI has a wild volatility setup. Front month's option are trading at 285% IV, while back months is at 206%. That's a huge opportunity for traders who know how to play the spread. Today, we're breaking it down on one powerful trade, a long calendar spread that lets you exploit the volatility decay while keeping risk low. This setup could be a difference between winning with the time decay or crushing it. Stick around, let's dive in. Welcome back to the Sensa again. This is your host Zoheb here. Today, we are going to talk about SMCI, who, by their own ridiculous company name, Super Microcomputers, apparently sell super microcomputers. Seriously. If I asked a third grader to name a company that sold small computers, that is what they might say. At any rate, they have a peculiar thing happening with their implied volatility. First, a step back to remind folks in what implied volatility is. When we see the price of an option, it is implying a certain amount of movement reflected in that option. The simple way to see this is buy both a call and a put together, or price them at least and see what the total is. That's the plus or minus expected move, which is roughly the same thing. Now, due to the nature of implied volatility and time, the further out in the expiration of option, the lower the implied volatility. You might ask, what? The presence of additional time pushes the number of lower. So as we go through the time, implied volatility plots through like a line slope to the left. Like, I'm going to bring up the screen here and then we can see a quick check here. Right, this particular screen here. This shows a decrease in the volume curve, which is known as a contango. You don't want to be buying back month volatility and selling short-term volatility in contango. It's not favorable. And then there is SMCI. Front month volatility is 285%, and the back month is at 206%. This is a situation in which the buying the back the month, which is the low volume, and selling the front month, which is the high volume, is favorable. In theory, the front month option will decay faster than the back month, and the trader will profit from the difference. Both options are decay, one much faster than the other. Here, again, if you might ask super microcomputers what stock to buy or sell, from the charting perspective, SMC has an extremely volatile and prices possible on the verge. So bringing back my screen here, and if you can see this here in the screen, the price is possible on the verge of a breakout to the upside with a likely stopping point of 62.50, which is currently trading around 47.91. So $15 upside, or a reversion to the mean of $21. So those very large range for $50 stock. Rather than buying those crazy expensive option, we will sell them. I mean, sort of. Let's jump into how long calendars spread on SMCI, and here's how it's going to work. Again, what it is, a short call or a short put, doesn't matter. Options sold at the money in the front month or close to the expiration. To complete the particular spread, a long call or a long put, whichever you use in the first step, in an expiration further out in time than the first option. This creates a calendar spread. Why it works now in this SMCI, which is experiencing volatility inversion, this is also known as backwardation. So the option in the front expiration have premium baked in into the back. The risk reward is extremely favorable here, though the probability is still like could be half. We'll jump in there on the setup. All right, I'm bringing up the Sensa market here, and then I've already loaded up the long calendar call spread. You can go to Sensa market option strategy. You can pick the long calendar spread, which is trading around 47.91. So what I'm trying to do here is I'm buying a call position, which is on March 7th, which is going to be further out. And I'm selling a call position, which is going to be a slightly lower than that particular expression, which is going to be a February 28. The net code for this is just around 0.50, which is going to be a debit multiplied by 100. You see the debit price around $50 for this particular position. So what you're betting here is, in this case, the stock, if it is rallies somewhere around right around 48, this is where you're going to make maximum profit. The profit at this point of time looks like around $268, give or take. So anywhere in between this $39 and 50 $8 is your break-even price. Anywhere in between this is where you're going to be making profit, and anything right around the same price, which is right around this particular stock of $48, is where you're going to be having a maximum profit. Risk, your maximum loss is limited to the debit paid, which is around 0.50 for this particular at this current price, which is going to be like roughly around $50 per contract. When to use this particular strategy? You can jump into this if you come across an underlying that has elevated volatility in 1 month and a lower volatility in the next. It's likely a good candidate. In 1 month, it's likely a good candidate for a calendar spread unless there is an earning event. For this trade, I would put a hard stop right around $39 to the downside and $60 to the upside, and a hard close right around February 28. All right, I think let's finish off this calendar spread. Calendar spreads are actually really interesting trades and a great way to see how option pricing works. But don't just go blindly tossing a dart on the wall. Find a good candidate, just like this particular thing on SMCI. This is a good one. The risk reward perspective from a probability standpoint, it's kind of like so-so, but the profit range is huge. The actual underlying range is pretty massive as well. Still a good play. All right. Next time on the Sensa Edge, we'll dive into more of these particular strategies. Be sure to subscribe, leave a review, and follow us on the platform. Thank you all. See you all next time.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.